Hello class, welcome to another episode of B Grade Economics. This is Nate, your class leader. Let's get started. Today we're going to be going over the introduction to market capitalization. We'll discuss what market capitalization is versus price, market capitalization for bonds or for broad comparison, liquid and illiquid supply market caps, and their application limitations. So market capitalization is the value of a company or asset that's calculated by multiplying the total number of shares by the price of a share. So it would be the entire what you usually refer to or is seen as a comparative value. This is a very broad use for comparative value, but it is the total sum of all of the shares outstanding for a company. Share price is the price of a share is trading for. So that would be one individual share of a stock. So for common securities, it's calculated by price by the total number of shares. That would be your market cap. For commodities, it's priced by the total supply. That's the available supply. That's the market cap. And then when it comes to economic production assets, it gets a lot more complicated. The most basic forms would include like a sum of all prices. It would be the market cap. So one thing plus one widget plus one widget plus one widget, or the median price times the total supply would be another quick way to calculate it. Now, each different economic asset, such as homes versus cars, have a different way of calculating this, and they're much more accurate in that way. There's also different ways of doing it, and different organizations or government entities tend to do a different way of calculating these. So we'll find very quickly there's limitations there. If we look at Tesla, which is a great example today, they busted $1 trillion for their market cap as of Monday this week. And Tesla is priced per share at $1,024.86 as of the time of making this slide. The market cap was $1.01 trillion. So you can see the math on the bottom right corner, 1.01 trillion, and divide it by the total number of shares, and you get an estimated shares outstanding. The actual shares outstanding listed below at 990 million. We all know what Tesla is. It's essentially a tech and car company, and so when we talk about Tesla using it as a market cap comparison, people were obsessed, advisors were obsessed with comparing Tesla to car industries, and so they would use this to say that Tesla was overvalued compared to someone like Ford or GM. This was obviously a mistake because the company is not only a car company, they're a tech company. So then you also ask, what about comparing it to Google? Well, Google doesn't have manufacturing production on the scale that Tesla does. So again, market capitalization runs into some limitations, but we see that this method generally is accurate for the shares outstanding. So when we look at commodity market caps, we divide the total quantity that's available by the price, or multiply it by the price that it's currently trading for. So mining, you use above ground supply for the total produced supply that is confirmed. So in-ground supply would not normally be considered part of the market cap because it's not in the market. The market is instead the mining companies, because there's no, those would be called reserves. They're not able to be traded. They are the most illiquid form, and there are unknowns in mining, such as how much is actually in the ground versus what they test. Consumables, it's the total in circulation. So if it's timber, lumber, we don't call the trees part of the market capitalization, but we do call the random lengths of wood as part of the market cap. The gold market cap is approximately $11.490 billion right now, and the price per ounce is $1,807 per troy ounce. That's the unit of measure that's standard in the weights of precious metals, is troy ounces, which are just slightly above the weight of a regular ounce. And then if we do the math, it comes out to pretty close to what the estimated actual is. But the thing with mining, and as we talked about, metals that are lost over time, such as a little bit of gold and a lot of silver, we find that the actual amount that is above ground, it has some variance in representation. So there's generally an agreement among the industry on how they calculated how they got to 190,000 troy ounces above ground. And so the amount above ground is a estimate because the consumption is not always guaranteed to be accurate. Someone could have buried gold coins in their backyard, and we don't know that that's no longer part of the gold supply because those will be in the ground for the next 1,000 years. We don't know that. So we make assessments and assumptions. Examples in the production market, you look at housing as an example, it gets rather difficult very quickly. Let's say there are houses trading at 180,000, 95,000, $30 million, and $85,000. This is very location dependent. A house in Missouri or Arkansas versus Texas, the location alone on the land that's available, because land changes and that drives a lot of housing value, is both land and policy. And so when you try to do a total market cap for a housing area, it's not very useful because, one, the number is going to be very high, and so it won't really be used for comparison of much, but it also doesn't really show you what it's like across the board. So you may only want to use a certain region or area of the total housing supply in your town or in a subsection of the town to talk about the market there. But it's not as useful, and we quickly see these limitations come in on how we calculate this using a market cap for a produced commodity. The same would apply for cars, is that we don't know used car values across the board. There's a lot of off-market transactions that occur. The form of registry is self-reporting with cars, so the amount that you purchased the car for is not accurate on the legal statement. But we can see that we use the market caps for comparison kind of more like a race, because it really is irrelevant to somebody if your market cap goes above or below another market cap, but they are used in sort of a grandstanding comparison between major assets. And we can see here gold at 11.49 in a massive lead to something like Apple, which is one of the biggest and most valuable producers of personal electronic devices. When we look at Bitcoin, you can see that it's 1.187 trillion, and that might be a better comparison to something like gold when you're talking about value that is being used for savings. And you look at silver, and you can use those as like, well, if we use these as monetary assets, we can discuss about how much value is really being locked into them. But then it comes down to, like, there's more than just the market cap itself. For instance, half of silver is half of that 1.3 trillion in silver is in the industrial market versus Bitcoin has no industrial market. So these are comparisons for like a snapshot of how they're performing in the macroscape. But we obviously see very quick limitations in how we use them. But it is good to know what is the market cap, because the other way to use market cap would be, if a market cap is very low, how many multiples can I get before it catches up to the value of some other company? And that's where it becomes much more important. I'll say that again. Using a market cap to identify how many multiples are in front of the company or stock or asset to catch up to a comparative value of another company is much more useful. So if I want to say Bitcoin is going to replace gold, that would be a reasonable use of the market cap, because only 10% of gold's market cap is due to industrial supply. If I were going to say Amazon and Walmart's going to overtake Amazon in this argument, Walmart isn't even in the top 20. So, but it is in the top 50. So if Walmart was going to try to overtake Amazon, I could do multiples on where their market cap was and compare. This isn't a sound way to guarantee returns, but it is a way to calculate what's the probability that those returns actually occur or are going to occur if there's a company that is ahead of them by a wide margin. So when we talk about price, even the most basic introduction to supply and demand is necessary here. When we talk about liquid and illiquid supply, and this is where market capitalization matters to have a discussion about liquid supply, the entire housing market has a market cap, a total value of the market, but only some things are for sale, right? Not every house is for sale. Not every ounce of gold is for sale. Not every Bitcoin is for sale. And so in order to move the market cap, it's the same function as moving the price. In order to get someone to sell, the price has to go up, or the price has to stay stagnant long enough that someone else is seeking out opportunity elsewhere. And so it's an illiquid supply. You can consider it's locked up in a safe, not ready to be sold, but it'll come out of that safe and you can purchase the key for this price. That's what that person will sell it for. This applies to a house because but it is a more illiquid supply. Houses are harder to sell, harder to move, harder to transfer. But if the housing market moves up enough, you're more likely to get someone else to go and say, I will sell my home for the profits now, rather than having the home to live in because I can go rent somewhere else. This works especially if one area is up a lot and the rest of the market is not, because then that person might be willing to move somewhere else. But it doesn't work so well if all of the markets are up, because when you sell your house, then other houses are just as expensive. Illiquid and liquid supplies with gold. We see that it's harder to calculate illiquid supplies with gold, but we use things like the central bank holdings of gold, and we can see that they've been on an uptrend since 2006. They went through a small downtrend from 2015 to 2018, and then they've continued an uptrend again. But we can see that the growth is positive on central bank holdings, and so if we say that central banks are buying, people who believe in monetarism are buying, so individuals are, but the individual gold is more liquid. Now that's not to say central banks who are buying aren't also selling, but when they become net buyers, it means they're mostly bringing the gold in. And so if you talk about that as a demand function, then you can identify that the supply will drain out of the system as there is a limited supply. But we can't really tell, like especially in the private market, how much gold is actually transacting unless it's paper products like through the stock market. So physical gold, how do I know how much is trading, how much volume is moving? It's a lot harder to calculate. When it comes to liquid and illiquid supplies, we can look at something like Bitcoin where it's open source, and one of the cool things that you can do with this is you can actually track data across Bitcoin on where its supply is and how much of it is in each wallet. You can't necessarily tell whose wallet is what, but you can tell how much is flowing and how much they have in that wallet. So it's an open source that doesn't allow you to hide information. So from that, we've seen traders and investors develop methods of measure for value and where the liquid and illiquid supplies are. And so when we talk about an illiquid and liquid supply market cap, the more liquid or less liquid the total market cap is, and how much of the market cap is actually liquid supply, affects how easily the price is moved by holders. And so you can see with Bitcoin, as the supply becomes much more illiquid in the total supply held by long-term holders, then the price shoots up and then the long-term holders sell. And so you see these dips along the way. You can see that the long-term holdings continuously increase over time. And so obviously there's always a base of buyers, or at least has always been a base of buyers who refuse to let it go. And they only let it go when the price goes up enough to cause them to sell, and that causes the price to dip again, and then they go back to buying. So long-term holders buy the dips and sell the pips. With a stock, liquid and illiquid supply is also very difficult because it's not open source blockchain. We do use things like how many corporations, how many governments, agencies like retirement agencies hold the share, how many insiders hold the shares. And that'll give you a percentage of like how many are liquid versus illiquid. But insider holdings also matter for long-term holders, as in a company that's doing well long-term versus a brand newly listed company. Insiders or angel investors who are holding a share are much more likely to sell it if it spikes up on listing onto the New York Stock Exchange. So these are just things to consider on how liquidity and illiquidity play out in them, and you can use things like outstanding shorts to identify whether or not the supply is being suppressed. So you can see in this small chart here with the orange and blue, the Tesla price in blue and the Tesla percentage shares short. When the shorts go up, the price gets dropped. But if the price hits a wall, a limit on how low it can go with the shares, then the shorts have nothing else they can do because the price has gone too low. Everyone becomes a buyer. They have to become a buyer. And once they become a buyer, the price shoots up again. And so that these are liquid and illiquid supply comparisons that you can use, including how shorts will have to capitulate and become longs, or longs have to capitulate and become shorts. So again, that was market capitalization. I hope that helps in one of the most rudimentary concepts for investing and value comparison. We're still on bet number 1 for our 2x to $1 million. So continue to follow along. We'll see how well so far the NASDAQ has held up, but it is getting shaky. I believe that this will probably be the last trade before something else changes in that macro trend. But hopefully we can make our 2x from here, and then we can try to find our next trade. I've updated the syllabus. We have trading, savings, and investment, introduction to rudimentary technical analysis, risk and outcome asymmetry, and leverage. So we'll be going over those over the next few episodes. Follow me on Kobe.io to see how I actively manage a simulated account. Thank you for watching.